And we are live. Hello and welcome everybody to Capital Cosm Live. Nothing in this video is financial advice. Please do your own due diligence. I'm not a financial advisor, so don't pretend that I am. In this episode, we are going to look at some huge geopolitical shifts going on that are going to impact the energy market like nothing before. Let's give it a few more minutes. Let people come in. We are live, folks, so let's get some more people in and then take this thing on the road. There's some really exciting news to share with you guys when it comes to this energy transition. All right, well, let's go ahead and share this out to X, and then we'll get started. Exciting news to share with you guys. All right, guys, I think we are good. Let's go ahead and kick things off with China. China is replacing African loans with energy investments amid the faltering economy. All right, so it says here, the highlights. Chinese oil and gas investments are up 20x since the 80s. Beijing is eyeing diplomatic clout, future supply. Africa needs investment amid calls for an energy transition. So we've talked about this before. You've got the developing world, i.e. Africa, South America, the global South in essence, as well as certain parts in Asia and the Middle East that are wanting to industrialize and pretty much catch up to our way of life here in the West. And so they're tapping in. So China's kind of tapping into that. And as it says here, Chinese oil and gas investments are up a whopping 20%. So let's go ahead and dig into this article here. It says China has swapped cheap African loans with energy investments in a bid to bolster its influence and secure future oil and gas supply, as its domestic economic slowdown brings the era of Beijing's largesse on the continent to an end. For decades, Beijing flooded Africa with loans and grants. Beijing, as well as the IMF, the World Bank, everyone kind of piled on to Africa during the last century for its natural resource allocation there. There are a lot of natural resources that are being that make Africa a prime location to exploit from the West. And now China's getting into the action, but they're actually going in and putting their money where their mouth is, not just through predatory loans, but through actually investing in the African continent. So it says here, Beijing flooded Africa with loans and grants, funding an infrastructure rebuilding spree that included Kenyan trains, Juba's airport, and the Zimbabwean parliament. The spending defined China's role in what has been dubbed a new scramble for Africa. So just so you know, guys, it's been projected that the most populous country in the next 50 years, it's not China. Neither is it India. And it's not the United States. It's not any Western or Eastern country for that matter. It's actually Nigeria. Africa has been somewhat dubbed as China's China. And so China really benefits and needs Africa to kind of, get what they need from a natural resource perspective, in an affordable way. So they've invested in Africa, and it's only going to continue to grow. With China's economy faltering due to rising debt and the COVID pandemic, that generosity has diminished. Instead, energy companies have taken up the mantle. Today, the three main Chinese players, CNPC, CNOOC, and Sinopec, are collectively the four biggest energy investors in the continent, behind BP, Shell, and Italy's Eni. So, So collectively, these three Chinese companies are the fourth biggest energy investors in China. Fourth only to BP, Shell, and Eni. I'm not too familiar with Eni. It's quite a historical reversal. Harry Verhoeven says he's a senior research scholar at Columbia University. White shoe boy, it seems, told S&P Global Commodity Insights. Historically, China makes a lot of credit available to Africa and trades a lot with Africa, but actually has been rather reluctant for a number of reasons to actually invest, i.e., take direct ownership. And so this is why it makes it so significant, because you have these three Chinese companies actually putting their money, actual skin in the game, putting money, capital on the ground in Africa. On the end of Chinese loan giving, he said, contrary to a number of years ago, China does really need the money. Yeah. They've got a demographic problem in China. China is projected to lose, I think, somewhere along the lines of 500 million people over the course of the next century. But of course, they're over a billion. They're like 1.5 billion people. So there'll still be over 1 billion people in China. Might be a little less, actually. But that's how, this is kind of the mindset in China at the moment. According to data from the World Bank, China's annual GDP growth has fallen steadily from 14.2 to 3% in 2022. Yeah, that kind of makes sense. When you're coming from such a low base, any year-over-year change is going to be, it's going to be easier to get a big number like a 14.2. When your GDP starts to get up to, I think, like $30 trillion now, that's when it really becomes difficult to grow that on that same, that 10+% basis. So China's leveling out. It's at a 3% in 2022. And we've got mega projects in the pipeline. So it says here, data from S&P Global shows the number of Chinese energy investments in Africa soared 20x since the 1980s. Meanwhile, loans to the continent have plummeted since 2016. So loans are coming down, but investments are coming up. Among dozens of Chinese investments are Mozambique's 3.4 million MT per year. Not quite sure what that unit of measure is. Chat, if you know what that unit is, drop me a comment down below. This 160,000 barrels per day East African crude oil pipeline and Niger's Agadem oil project and pipeline, which will increase Niger's oil output from 20,000 barrels a day to 130,000 barrels a day upon completion. In most projects, Chinese energy companies hold stakes alongside international oil companies. However, investments in Kuwait, Niger, and terraplate Mozambique demonstrate the willingness of Chinese companies to operate in challenging regions. I mean, that kind of follows in line with, the common sayings that we often hear as investors. You want to buy when there's blood on the streets, well, or when there's a coup, or when there's terror plaguing an entire country. You want to get that bottom end. And it seems like that's China's MO. The spate of foreign investment decisions has increased the total gas reserves of Chinese projects. Okay, so Glenn Duke says MT is metric tons. Okay. Yeah, that makes sense. I don't know why I didn't think that. Thanks, Glenn. The spate of foreign investment decisions has increased the total gas reserves of Chinese projects in Africa from 3.44 TCF. Not too sure what TCF means now. If anyone in the chat knows, drop a comment. To 22.52. So that's a pretty big multiple. In addition, China has pumped money into renewable energy projects in Africa, as well as critical minerals from cobalt to lithium that will power the global energy transition. Yep. So Africa is one of those places that is closer to the floor than it is to the ceiling. There's a lot of room for growth in a place like Africa, and a global power like China has identified that opportunity. Future energy supply, long treated as a playground for great powers, Africa's economic and population growth projections, and rising diplomatic clout have prompted a battle to secure influence on the continent involving China, Russia, the U.S., colonial powers in Britain and France, and even Turkey and the Gulf states. So it's a battle royale to secure energy supply, future energy supply by way of Africa. While Russia has dispatched mercenaries to prop up regimes, China has used trade, grants, loans, and more recently, investments. China is the largest trading partner and fourth largest foreign investor in Africa, said Li Bian, a policy fellow at the London School of Economics. All right, so using Xi Jinping's landmark Belt and Road Initiative, she added, China has been enhancing policy coordination, infrastructure connectivity, trade, and financial integration, and people-to-people connectivity. Neil G, so he says TCF stands for trillion cubic feet. Thanks, Neil. Experts say the BRI is part of a wider effort to amplify Beijing's voice on the world stage by securing the support of the global South, which beats developed nations on population size and growth and economic development. So, like I said before, population-wise, a lot of it is going to come from Africa, Afghanistan, parts of South Asia. I'm not too sure about South America, but I could be wrong there. But those parts of the world are where you are going to see the most opportunity present itself. Beijing's largesse in Africa has long prompted accusations of debt trap diplomacy and vote buying. According to researchers at Aid Data, key energy investment recipients made a habit of siding with China at the UN. Nigeria does so 76% of the time, compared with Egypt's 75%, Algeria's 79%. Last year, the UN Human Rights Council rejected a Western-led motion to debate China's alleged human rights abuses with emerging oil producers Cameroon, Cote d'Ivoire, the Ivory Coast, Gabon, Namibia, Mauritania, Senegal, and Sudan, all backing Beijing. So you can kind of see the power shifting across from one pole to the next. The pole is actually kind of diverging. You're going from a unipolar world, this is led by G7. Now it's kind of diverging out. You've got the G7 as well as the BRICS on the other side, led by China. Beyond diplomacy, however, Chinese oil and gas investments are also about securing future energy supply. According to analysts, the world's largest crude importer buys a wide variety of African crudes, both sweet and sour. Now remember, there's two different types of oil. I mean, in a very general sense, there's different, more flavors than that. But from a high level point of view, you've got light sweet and you've got heavy sour. And they're not interchangeable. Here in the United States, our refiners can only take in heavy sour, which we don't produce. We produce light sweet. So the oil that we extract is unusable from a domestic POV. And so, oftentimes people, kind of scratch their heads like, why are we cutting deals with Venezuela and all these other countries when we can just produce our own oil? Well, we could. I mean, we would just have to find some way to refine light sweet oil, which is what we produce. But the infrastructure that's in place has no capacity for that. So it says here, the world's largest crude importer buys a wide variety of African crudes, both sweet and sour, but its refiners prefer slightly sweet grades, such as the Republic of Congo's and Angola's Girasol. China imported 1.1 million barrels a day of crude from West Africa. In Q2, around a tenth of total Chinese imports, according to CAS data. Be really interested to see if there's any growth there year over year or some sort of trend to look at. A unit of S&P Global Commodity Insights last assessed Girasol at a premium of $3.90 a barrel to dated Brent at October 10th. In the Chinese outlook on global energy, it's an all of the above strategy. So yes, they invest a lot in solar. They double down on EVs, but they also still build a lot of coal plants. And they also try to secure oil and gas. So yes, throughout the course of human development, we've never replaced a lesser dense form of energy with a higher dense form of energy. No, we've kept the lesser dense form of energy, but we've stacked the higher dense form of energy on top of it. There's never any substitution. And that's exactly what we're seeing in this article. This goes hand in glove with history. Much needed investments. It says African producers have been able to boost production and match Chinese oil demand in recent years, with underinvestment and technical issues at aging fields causing production in established producers, including OPEC members Nigeria, Angola, and the Republic of Congo, to fall. Meanwhile, China, which imports 10 million barrels a day of crude, has boosted imports of cheap Russian oil since the Ukraine war, initially at the expense of West African petrostates. So it says here, this is a chart. Okay, so this goes all the way back to Q4 2021. And this is looking at Chinese imports of WAF crude are returning to pre-war levels. So these are all of the imports from Africa to China. And you can see here in Q3, as soon as the Ukraine-Russian war hits, around Q1, towards the tail end of Q1, you started seeing this decrease of African imports to China. But over the course of a year now, imports have begun rebounding up. So China has begun reopening more and more of its trade with Africa. However, rising Chinese investments in the continent could change the outlook for African producers who are seeking investments following a wave of IOC divestments from mature basins in favor of frontier plays like Namibia and Guyana. S&P Global data shows Africa needs significant new drilling to maintain current production levels. Yep. Meanwhile, the Western energy companies and banks have grown reticent to fund African fossil fuel projects, including Uganda's EACOP pipeline, leaving space for Chinese lenders to fill the void. If Western energy companies won't do it, then China will. Beijing also appears less concerned about human rights abuses and poor governance in emerging African producers. So yeah, they don't really give a shit about ESG or any of that stuff in China, which remains a deterrent for many Western oil CEOs. China's first major energy project in Africa was in Sudan in the 1990s, when a bitter civil war led to a raft of Western sanctions. On the East African country. Get this out the way. Through that investment, Verhoeven said, China sent a signal to other partners that no matter what kind of PR noise or sanctions will be there, and they'll be consistent. So, yeah, guys, China isn't just now making a play. They've been making a play for Africa. And it's only going to intensify. It's only going to intensify. So, and these kind of things, these aren't just unique to China, to Africa. You can bet your bottom dollar the places like Afghanistan, that places like maybe Argentina, maybe other countries in Southeast Asia are also going to be courted in the same way that Africa is. Let's stay on energy. And I found this article I thought it was really interesting to share. So the title is, Today's Energy Bottleneck May Bring Down Major Governments. And as you know, energy is the foundation to civilization. When you start having things like energy shortages, you start having famine, you start having, obviously, no transportation, no power, quality of life goes down. There's a clear correlation between energy and GDP and quality of life. So, for countries for regions that fail to secure energy to their populations, they're going to face some serious turbulence, revolutions, and all that kind of stuff. And so let's go ahead and dive into the article. So it says here, recently, so this is from Our Finite World. Recently, I explained the key role played by diesel and jet fuel. In this post, I will try to explain the energy bottleneck the world is facing because of an inadequate supply of these types of fuels and the effect such a bottleneck may have. The world's self-organizing economy tends to squeeze out what may be considered non-essential parts when bottlenecks are hit. Strangely, it appears to me that some central government may be squeezed out. Countries that are rich enough to have big pension programs for their citizens seem to be especially vulnerable to having their government collapse. And here in the United States, we've just had it really good for really long. It's kind of blinded kind of divorced us from reality. Kind of taken us away from what really matters. And so this is a chart of a world supply of diesel and jet fuel per person. So as you can see here, supply has been kind of range bound for the better part of 30 years, 40 years. Somewhere around 60 gallons to 70 gallons per person per year of diesel. Looks like we peaked somewhere up here in 07, and pandemic crashed. Here's the thing with the pandemic, guys. We shut down the entire economy, and yet diesel demand for the average person only went down 10 gallons. Okay? 1/7. So it just goes to show you how ubiquitous energy is in our society. It's not just transportation. That's just one sliver of the pie. It's one slice of the pie. You can see here it's rebounded back, but it has not rebounded back to the 2019 levels yet. So let's continue. The squeezing out of non-essential parts of the economy can happen by war. Yes, which we've always talked about. Wars are inflationary. So if you're long wars, one way to play that is through being long inflation and through being long commodities and energy. But it can also happen because of financial problems brought about by not sufficient actual goods and services to go around. An underlying problem is that governments can print money, but they cannot print the actual resources needed to produce finished goods and services. So yeah, here in the United States, last GDP print year over year was 4.9%. Now, GDP is a stupid way to measure productivity because it's naive to the qualitative, to the quality of the total transactions made. I talked about it in my last live stream. If all of us just buy a bunch of OnlyFans subscriptions, that's going to add to the GDP. But did it produce anything of value? No. And so here we have all this GDP, but do we know what fraction of that? How much of that is actually going to productive means? We don't, because GDP doesn't measure that. I think that in the current situation, a squeezing out for financial reasons, or because legislators can't agree, is at least as likely as another world war. So, for example, the U.S. is having trouble electing speaker. So this is couple days old. Let's go ahead and power through this because legislators disagree about funding plans. I can imagine a long shutdown occurring because of this impasse. Well, that didn't happen. Perhaps not this time around, but sometime in the next few years. Such a disagreement may lead to permanent shutdown of the U.S. government, leaving the individual states on their own. Programs of the U.S. government, such as Social Security, Medicare, would likely disappear. It would be up to the individual states to sponsor whatever replacement programs they are able to afford. And the state governments don't have the luxury of just printing money like the federal government does. In my view, we are in the midst of a great squeezing out. The economy, and in fact, the entire universe, is a physics-based system that constantly evolves. Every part of the economy requires energy of the right types. Humans and animals eat food. Today's economy requires many forms of fossil fuels, plus human labor. This evolution is in the direction of ever greater complexity and ever greater efficiency. Right now, there is a bottleneck in energy supply caused by too much population relative to the amount of oil of the type used to make diesel and jet fuel. My concern is that many governments and businesses will collapse in response to what he calls a second squeezing out. In 1991, the central government of the Soviet Union collapsed following a long downward slide starting about 1982. Let's see, does he have like any charts here? No, he doesn't. Let's continue. All parts of the economies, including government, orgs, businesses, constantly evolve. They grow for a while, but when limits are hit, they are likely to shrink and may collapse. The current energy bottleneck is sufficiently dire that some observers worry about another world war taking place. Yeah. These governments are facing an existential crisis. They have to get the energy, but at the same time, they want to continue this facade of wanting to do what's best for the planet. So, in trying to get this energy out, they're trying to exert hegemonic control of the world. Both poles are. We can make an argument of who's been more fair or less fair, but this is basically what it boils down to. Such a war could change national boundaries and reduce import capabilities of parts of the world. This would be a type of squeezing out of major parts of the world economy. In fact, shortages of coal seem to have set the stage for both World War I and World War II. I'm sure you've heard the term, all wars are banker wars, but what about energy? I mean, paper money doesn't mean jack squat, without anything to power the society from which you can buy stuff from. Each squeezing out is different. When there are physically not enough goods and services to go around, some inefficient parts of the economy must be squeezed out. Payments to pensioners seem to me to be particularly inefficient because pensioners are not themselves creating finished goods and services. World leaders would like us to believe that they are in charge of what happens in the world economy, but what these leaders can accomplish is limited by the actual resources that can be extracted and the finished goods and services that can be produced with these resources. When there are not enough goods and services to go around, unplanned changes to the economy tend to take place. These changes work in the direction of allowing parts of the system to go forward without being burdened by the less efficient portion. So essentially, all of these goodies that we have here, it's merely a luxury. Hate to tell you. The importance of diesel and jet fuel. Diesel and jet fuel are important today to today's industrial economy because they fuel nearly all long-distance transportation of goods, whether by ship, train, large truck, or airplane. Diesel also powers most of modern agricultural equipment. Without the use of modern agricultural equipment, overall food production would decline. So, food, transportation, These are all mechanisms that are downstream of diesel and jet fuel. So notice how this kind of really sheds light on the importance of those two energy sources. When you've got a supply bottleneck of either of the two, then people either aren't going to eat, or they're not going to get from one place to the other, or both, or heat their home, etc. Without diesel, there would be many problems besides reduced food production. Diesel is used to power many of the specialized vehicles used in road maintenance. Without the ability to use these vehicles, it would become difficult to keep roads repaired. Without diesel and jet fuel, there would be an electricity problem because transmission lines are maintained using a combination of land-based vehicles powered by diesel and helicopters powered by jet fuel. Without electricity transmissions, homes and offices without their own solar panels and batteries wouldn't be able to keep the lights on. Gasoline pumps require electricity to operate, so they wouldn't operate either. Without diesel and electricity, the list of problems is endless. So yeah, these are all the problems that we're aware of. Now, think of all the problems that we're not aware of, the things that we don't know that we don't know. Which is a lot. You know, humans are not good second, third, they're not good thinkers when it comes beyond the first order effects. So many things. These are all the things that we can identify. Now think of all the things that we can't identify play out. The reason why we hear so much about green energy is because making people believe that a green revolution is possible provides many temporary benefits, such as the extra debt needed to subsidize green energy indirectly increases GDP. GDP calculations ignore whether added debt was used to produce the added goods and services counted as GDP. So yeah, GDP is a very naive calculation. GDP doesn't care what you're spending your money on, how it's being financed. All it cares is that money went from one hand to the next. And so the GDP calculations ignore whether transactions were created by adding debt to the government. Manufacturers can pretend that their products, such as vehicles, will operate as they do today for years and years. Yeah. Educational system is given many more areas to provide courses in. That is definitely true. I mean, there's so many things you can go and major in college nowadays. Anything, all of these programs with the word studies at the end of it, essentially. I think that's what they're talking about. Citizens are given the hope that the economy will grow endlessly. Young people are given hope for the future. Sorry, young people, the future is hopeless. Just give up. Just give up. Just go eat the bugs. Eat the bugs. Politicians look like they are doing something for the voters. Oh, we all know, politicians, they never stop doing things for the voters. It's just an unending geyser of goodies and goodwill. Definitely. Unfortunately, by the time that the debt comes due to pay for the subsidized green energy, it will be apparent that the return on this technology is far too low. The overall system will tend to collapse. Green energy is only a temporary band-aid to hide a very disturbing problem. Its impact is tiny and short-lived, and it cannot prevent climate change. Mic drop. Number 4, energy bottlenecks are a frequent problem. Energy bottlenecks are a frequent problem partly because the human population has tended to increase. Ever since early humans learned to control fire, at the same time resources such as arable land, fresh water supply, and minerals of all kinds are in limited supply. Extraction becomes increasingly difficult over time, requiring more inputs to produce the same output. So all the easy stuff has been extracted. When you open a new toothpaste tube, you'll notice that it's much easier to squeeze it, to get toothpaste out of the tube as soon as you open it. You really don't have to exert that much energy or pressure. Now, when you pretty much use up 95% of the test tube, then you've really got to squeeze at the very bottoms of the, not test tube, but toothpaste tube. You've really got to squeeze at the very bottom of the tube to extract what little toothpaste you can get out of it. All right, where were we? Extracting more fossil fuels to meet energy needs of a growing economy may look like it would be easy, but in practice, it is not. As a result, energy bottlenecks, civilizations often collapse. Sometimes war with another group is involved. In such a case, the population of the losing civilization falls. It's not good news. Not good news for us. Glenn Duke says GDP is also measured normally, and they use an artificially low deflator based on the CPI. Yeah, I mean, the CPI is definitely deflated. There's so many incentives to keep the CPI underreporting, including cost of living adjustments to the Social Security, old timers, and etc. So that doesn't surprise me, Glenn. The standard supply and demand models of economics make it look like prices will rise in response to fossil fuel shortages. The discussion in Section 4 shows that energy supply bottlenecks often occur. When they do occur, the response is very different. So what do we got here? So this is from Wikipedia, the price P. So we've got the price here, P, determined by a balance between production at each price, supply S. So we've got supply here, and then we've got one scenario of demand here for D1 and another scenario D2. So when you actually go from Q, Q is the quantity sold of the product. The model of many economists is far too simple. Based on the model shown above in Figure 2, it's easy to get the idea that a shortage of oil will lead to a rise in prices, right? So you've got less supply, then you'd anticipate higher prices, right? So you're getting higher prices at a, so this is saying that what happens to demand as supply grows. But as supply contracts from D2 down to D1, you'll notice that we go down the supply curve here, right? Supply is being constricted. So now you have to pay the same price you had to pay for a product with at this level of quantity sold as you would have all the way out here on the D2 level. So it says here, when the bottlenecks appear, the real situation is quite different. For example, increases in oil prices tend to cause food prices to rise and thus inflation. Politicians know that citizens don't like inflation, therefore will not vote for them. As a result, politicians tend to hold down prices. You know what happens next? The resulting prices tend to fall too low for producers, and they start producing less rather than more. Energy products of the right kinds are essential to making every part of GDP. If there is not enough of the right kinds of energy products to go around, what I call some kind of squeezing out is likely to take place. Early on, there may be changes that reduce energy consumption, such as cutbacks in international trade. More businesses may fail. Eventually, some parts of the world economy may disappear, such as the central government of the Soviet Union. So when you really hit shortages of this magnitude. The politicians come in, they try to help, they never help. They always make things worse, and they do make things worse. They cause even more shortages, higher prices occur, inflation gets worse, and there's nothing left they can do. It just completely crashes their economy. Number 6, when there is not enough energy of the right kinds to go around, spreading what little is available thinner does not work. As an example, if people need to eat 2,000 kilocalories a day, and if the food supplies available would only supply 500 kilocalories per day on average, giving everyone the same quantity would lead to everyone starving. Similarly, if a communist government gives every worker the same wage, lateness and slacking off become huge problems. Experience in many places has shown that equal pay for all, regardless of their native abilities, responsibilities, or effort, simply doesn't work. Somehow, diligent work and greater responsibility needs to be rewarded. Right. So, a basic question in kind of debunking things like Marxism and socialism, all that kind of stuff, is, do humans respond to incentives? That's really it. Which they obviously do. And so knowing that humans respond to incentives, that completely demolishes the entire premise of Marxism. It becomes apparent to the naivete of what the entire philosophy lies on. The foundation is completely crumbled. When an energy bottleneck occurs, leading to too little finished goods and services and total being produced, what I call a squeezing out takes place. Such a squeezing out may be initiated in many ways, including a war, angry citizens overturning a government, financial problems, or a shift in climate. Now, the politicians, the bureaucrats, are going to become aware of this point eventually. Eventually, they're going to become aware of the fact that there's nothing they can do. There's no legislation they can pass to actually mitigate the problem. There's nothing they can do, at least in the near term. And they're going to anticipate revolution. So this gives politicians, the government, bureaucrats more and more incentive to actually go out there and look for external enemies and create wars, to shift the attention off of them to an external enemy. The winners in squeezing out end up ahead. The losers see collapsing institutions of many kind, including failing businesses and disappearing government organizations. Number 7, most people do not understand the interconnected nature of the world economy and the way the whole system tends to evolve. So there's so many dependencies. There's so many nth order effects that the human mind simply can't comprehend. When you initiate an action, it's sort of like the butterfly effect. A butterfly flaps its wings on one end of the planet. Over enough time, you'll get something along the lines of a tropical storm or a hurricane on the other side of the planet. Because a small change eventually dominoes into a bigger outcome the longer you move forward in time. The universe is made up of many temporary structures, each of which need to dissipate energy to stay away from a cold, dead state. We are all aware that plants and animals behave in this manner, but businesses of all kinds and government organizations also require energy of the right kinds to grow. Things get much of their energy from financial payments that act as temporary placeholders for goods and services that will be made in the future, using various types of energy, including human labor. Strangely enough, because of the physics of the situation, businesses and government organizations are also temporary in nature, and in some cases, they also evolve. So in physics terms, all of these structures are dissipative structures. Physicist Francois Rodier writes about this broader kind of evolution in his book, blah, blah, blah. In fact, economies themselves are dissipative structures. I've written about the economy as a self-organizing system powered by energy many times. So yeah, the economy is in a state of becoming. The economy is never still. It's always becoming something else, tending towards some future state of evolution. All of these self-organizing structures eventually come to an end. History is full of records of economies that have collapsed. The book Secular Cycles by Peter Turchin and Sergei Nevedov analyzes 8 of these failed economies. Populations tend to grow after a new resource is found or is acquired through war. Once population growth hits what Turchin calls carrying capacity, the economies hit a period of stagflation. This period lasts 50 to 60 years in a sample of 8 economies analyzed. Stagflation was followed by a major contraction, typically with falling or overturned governments and declined overall population. So yeah, society X discovers resource Y, and they live off the hog for some given amount of time. Eventually, the population grows too much, and the resource dwindles to become too little, and you've got stagflation, and eventually the entire economy crumbles after about 50 to 60 years. All right, number 8. Logic and some calculations suggest that the world economy is likely to be reaching a major downturn just about, now. One way of estimating when a major contraction or squeezing out would occur would be to look at oil supply. We know that U.S. oil production hit a peak and started to decline in the 1970s, changing the dynamics of the world economy. This started a period of stagflation for many of the wealthier economies of the world. Adding 50 to 60 years to 1970 suggests that a major downturn would take place in the 2020 to the 2030 timeframe. Wow, that's actually right on the nose. So, U.S. oil production peaked and started declining in the 1970s. And based off of this book, Secular Cycles, they say 50 to 60 years of stagflationary growth. And then, you eventually have a major contraction. And if you add in 50 to 60 years, that takes you to the year 2020 to 2023, which is where we're at. Since it was the wealthier economies that first entered stagflation, it would not be surprising if these economies tend to collapse first. So yeah, we're first in line, folks. There have been several studies computing estimates of when the extraction of fossil fuels would become unaffordable. Back in 1957, this Rear Admiral Hyman Rickover guy of the U.S. Navy, he gave a speech and he said, he talked about the connection of the level of fossil fuel supply to standard of living of an economy and to the ability of its military to defend the country with respect to the timing of limit to affordable supply. He said, total fossil fuel reserves recoverable at not over twice today's unit costs are likely to run out at some time between the years 2000 and 2050. If present standards of living and population growth rates are taken into account. Well, Mr. Rickover, well done, sir. Looks like you got it right. I mean, he did put out a fairly expansive time horizon, 50 years, but he got it just about right. We're right in the middle of that 50-year period. Confusion arises because some people would like to believe that fossil fuel prices can rise to extraordinarily high levels, and this will somehow permit more fossil fuels to be extracted. However, as I discussed in Section 5, the problem is really two-sided. Politicians want to hold fossil fuel prices down to prevent inflation, while oil producers, such as OPEC, plus choose to reduce production if prices are not sufficiently high to meet their demands. So these politicians, they're unable to see past their nose. They're economically illiterate. An easily missed point is that tax revenue from the sale of oil is often a large share of the total tax revenue of oil exporting countries. Because of this issue, in order for prices of oil to be adequate for oil exporters, they must include a wide margin for payment of taxes. These taxes are used to support the rest of the economy. For example, in Saudi Arabia, taxes provide support for huge building programs that provide jobs for citizens but are of questionable long-term value. These projects keep citizens happy, at least temporarily. Without adequate supply from a subsidy from tax revenue, citizens would want to overturn the government or, since they form collapse. All right, number 9. So number 9, the energy problems are easily hidden because scientific models are considered to be important in forecasting the future. These models tend to be misleading because they leave out important elements regarding how the economy really works. So I highly recommend you guys check out a book called The Black Swan by Nassim Taleb. And he basically talks about this. I mean, when it comes to economists and any sort of expert that thrives in a domain where their ideas aren't held accountable in the real world, like these economists, for example, people like doctors or engineers, if an engineer builds a bridge, I mean, they're going to see the fruits of their labor instantaneously, whether the bridge collapses or not. And so they're held to that level of accountability. They have skin in the game when it comes to their work. Doctors do as well. I mean, the doctors see real life consequences to their treatment plans, to their treatments, to their diagnoses. And so when it comes to these economists, I mean, they're basically siloed into their academic circles. And all they're doing is just churning out these theories and papers that aren't really being tested in the real world. And so they publish all these papers, and they also end up citing each other's papers in the process. So it just becomes one huge human centipede process where they're just they're just consuming one another's species over and over and over again. And so the entire premise is bunk, and they're never right. I mean, that's why you get the old saying, you can get two economists in the room together, and you're never going to find two economists that ever agree on anything. Simply because the economy is far too complex, and our minds are far too simple to really understand the economy at a deep level. And so with these economists, they never get to see their recommendations for the most part. They never, none of this, they're never held accountable in the same way an engineer might be held accountable for building a bad bridge. A doctor might be held accountable for a bad prescription and so forth. So highly recommend Black Swan if you haven't already. Check that book out. But let's go ahead and hop back in to the article. So it says here, the easiest models to make are the ones that seem to say the future will be very similar to the recent past. So yes, there is this tendency in people to want to fight the last great war. Okay. The past is finite, but the future is infinite. That's why it's always a fallacy to try to impose a finite history on limitless future potential. These models miss turning points. They assume that growth will continue even though resource extraction can be expected to become more difficult. Some examples of overly simple models include the following. Money is a store of value, not if the economy has stopped functioning properly because insufficient energy resources are available. Forecast of Social Security payments. Payments recipients will be able to receive in the future are overstated. I.e., in other words, it takes energy of the right kinds to produce the goods and services that the elderly require. If the economy is not producing enough goods and services because of energy extraction limits, the share that pensioners can receive will need to fall so that workers can be paid adequately. Inflation-adjusted benefits to the elderly must be much lower or disappear completely. Yep. Climate models give high estimates. These models miss the real-world difficulty of extracting fossil fuels. They also assume the economy can grow indefinitely, greatly overstating the future CO2. So they're taking past behavior and assuming future performance. It's the one thing that you always hear about in the investment circles. Past behavior does not indicate future performance. Future energy supply based on the reserve to production ratios give high estimates. In this case, reserve amounts are often puffed up numbers to make oil exporting countries look wealthy. Energy return on energy investment models greatly overestimate the value of intermittent wind energy. So it's easy to assume that all types of energy are equivalent, but intermittent wind and solar cannot replace diesel and jet fuel. Right, so what happens when it's wintertime in Europe? It's cloudy. Or wintertime anywhere, really. It's cloudy. What are you going to do with your solar panels? What are you going to do when there's no wind gushing around? What are you going to do with your wind farms then? Oh, we got Uselink in the house. How's it going, Uselink? Going good, man. Yeah, I appreciate it, man. Thanks for the congrats. We're going to cover some uranium towards the end. We're going to get into some charting. Don't worry, man. We need to get another stream going, you and I, Uselink. Get another dual charting episode. All right, let's go number 10. Added complexity is not a solution to our energy problems. Many people believe that if we can just be smarter, we can solve our energy problem. We can add more fuel-efficient engines, more advanced education, and more international trade, for example. Unfortunately, many things can go wrong, leading to an upward energy complexity spiral. Difficulties include... Wait, can you guys hear a baby in the background? Or is Usein just messing with me? Back to the article. Complexity changes with the best payback tend to be discovered and implemented very early. Added complexity may lead to higher energy consumption if cost savings result. For example, more vehicles may be sold if reduced fuel consumption makes their operation more affordable to a wider number of users. So yeah, I mean, complexity by definition does not make things more simple. The more you have complexity in things, there's more points of failure. Wage disparity results because the wages paid to highly educated employees and those in managerial positions leave little funding available to pay less skilled workers. Less skilled workers indirectly compete with similarly skilled workers in low-wage countries, further holding their wages down. So, all right, Uselink So I don't know. It might be your baby, man. You know, one of your 20 kids you got there. Yeah, but my kid, she has a really loud cry. So I would not be surprised if you could actually hear her. So it says here, it is clear that we are now moving past the limits of complexity. For example, international trade as a percentage of GDP has been falling for the world, the US and China. So this is a chart of, we've got percentage of GDP. Okay, so trade is a percentage of GDP. All right. So we've got the world peak. So we've got world GDP, percentage. We got world trade, overall world trade as a percentage of GDP. Here in blue, we've got China in gray, and then we've got the U.S. here in orange. So in all three of these analyses, it seems like we peaked around 2005, mid 2000s, and across the world, in China and the U.S., trade is in the case of China, it's becoming less and less percent of GDP. That's not really surprising because of the various economic wars that we've kind of thrown at China here in the U.S. or over the last decade or so. So a lot of it has to come back. A lot of that GDP has to come back from to within the borders of China. Countries are now actively trying to bring supply lines back closer to home. Trips for goods across the Atlantic and the Pacific Oceans are being reduced, saving diesel and jet fuel. All right, number 11, repayment of debt with interest acts like a Ponzi scheme. If there is inadequate growth in the energy supply, so the capital needed to service the debt essentially doesn't exist if there's not enough energy to produce, to create value, to push forward production across the world. If you owe $1 trillion and you're on an island with sticks and stones, you're not going to produce $1 trillion worth of value on that deserted island. Doesn't matter how many people you have. I mean, over time, if you have enough people, the network effect might take hold, and you'll advance that way. But you need resources, you need energy to actually create GDP. Again, GDP and energy are tightly correlated with one another, very, very reliably so. Most people today do not realize the extent to which the entire financial system is dependent on growing, inexpensive to produce energy supply of the right kinds. It takes physical resources of the right kinds to produce goods and services. Resources such as fresh water, copper, lithium, and fossil fuels require more and more energy consumption to produce the same amount of supply, because the easiest to extract resources are extracted first. Yeah, the stuff that's further down underground, further deeper into the mine, you're going to have to spend more energy to get the same amount of goods that you would have X number of years ago. When the economy is far from limits, adding more debt or other types of promises such as shares of stock, etc., does seem to increase demand for finished goods and services, and this in turn tends to increase the production of fossil fuels and other commodities. Thus, for a while, increased debt does indeed increase energy supply. Okay? So, when you're at the very start of this cycle, actually increasing debt, creating more credit lines available for energy extraction, commodity extraction, isn't such a bad idea, because you're going to get a return on investment for those ventures. So you're going to pull out energy, and it's going to produce more value. It's going to be used for other value generating purposes, and so it doesn't harm the economy in the way that it does further out into the cycle, when pulling the stuff from the ground just becomes too costly, to the point where it might not actually benefit you to do so. But when we start reaching extraction limits, instead of producing more fossil fuels and other commodities, higher debt tends to produce inflation. So in other words, more money plus practically the same amount of finished goods and services tend to lead to inflation. So if you were spending $1 on a gallon of gasoline, let's say, and that gallon of gasoline produced $2 worth of goods and services, that was a pretty good return on investment. But now you've got to spend $2 for that same gallon of gasoline. It's not so good of a proposition now is it? Because you've got to go further down into the extraction curve. The cost curve just becomes higher and higher to pull these resources from the ground. This is the issue central banks are up against today. Central bank raise interest rates in response to the higher levels of inflation, partly to compensate lenders for the inflation that is taking place, and partly to make their own economies more competitive in the world economy. The combination of higher interest rates and higher inflation is problematic in many ways. Before we get to that, see you later, Uselink. I appreciate you, buddy. Thanks for popping in. Number A. All right, so ordinary citizens find that they must cut back on discretionary goods and services to balance their budgets. This tends to push economies in the direction of recession and debt defaults. Some citizens find they need to apply for government assistance programs for the first time. Number 2, businesses find it more difficult to operate profitably with higher interest rates and inflation. Businesses increasingly expand in programs supported by government subsidies, such as those for electric cars and batteries, as it becomes difficult to make a profit without a subsidy. In the U.S., default seems especially likely on commercial real estate loans. So you push businesses to become more dependent on the government teat, if you will. As the late, great Dusty Rhodes would say. Just the if you will part, not the government teat part. Number 3, governments become especially squeezed. Many of them find that their own tax revenue is falling at precisely the time when citizens need their programs the most. So when it becomes harder to finance, things like your home loan and car loans and all other matters of that nature, and when inflation really eats away at the consumer, then they're not going to spend money. GDP is going to come down, and as a result, so will tax revenue. And when tax revenue comes down, it becomes more difficult to finance the interest on the debt, especially at these higher levels of interest. So, this entire thing is a doom loop when you get down to it. Government also find that with higher interest rates, interest costs on their own debt rises. Subsidized programs increasingly seem to be needed to keep the economy operating. The number of retirees also grows year after year. A government debt level spiral, as shown in for the U.S. in Figure 6. Where's Figure 6? Okay, it's probably all the way down here. So we're 30 trillion right here. The big 3-0. $30 trillion in debt. That's the COVID spike right here in 2020. With all these issues, the world becomes increasingly prone to war. Political parties and even groups within political parties find it increasingly difficult to agree on solutions to problems. The stage seems to be set for an array of worrisome outcomes, including major debt defaults, failing governments, and even widespread war. So when all else fails, they take you to war. All right, number 12. The world economy was able to grow rapidly in the 1950s to 80s period because of a rapid rise in energy consumption. Now there's an energy bottleneck. The recent increases in interest rates seem likely to burst debt bubbles. They may even squeeze out some major economies with pension programs for their citizens. So, energy was easy to extract, like we talked about before. And so consumption, came easy as well. There's a lot of consumption to be had. But now that's not so much the case. And, these interest rate rises, it's becoming increasingly harder to service the debt. Tax revenues are down because people aren't consuming as much. There's less demand. And this is where you start to see the bursting of these debt bubbles and people out of their pension programs. So if you look at this chart, so you've got the 3-month T-bill here in blue. You've got the market yield for the 10-year in blue. Okay? So this is the Fed funds rate here in blue, essentially. And the 10-year yield here as well. And the 10-year hasn't been this high since mid-2000s. And Fed funds rate hasn't grown this fast since the 80s, I'd say. You look at this slope, it's almost vertical. All right, so it says on figure 4, which is what we just looked at, significant rises in interest rates up until 1981 correspond to a huge increase in energy consumption in the 1950s and 80s period. All right. So we had this huge increase in interest rates from the 50s to the 80s. I don't know if you can see it. From here to here. Notice how interest rates went up substantially. Well, if you look at this chart, from that same time period, you had this rapid growth of energy consumption per capita. So society is able to service the interest to the debt when you've got all of this energy to produce value with. Today, we don't have that luxury. All right, so the rapid rise in fossil fuel consumption in figure 5 was the reason why the economy was able to grow as rapidly as it did in the 1950s and 80s. Yep. Fossil fuels were easy to pull out. Lots to be consumed, produce GDP with. Raising interest rates acted like brakes on the economy and lowered oil prices. The Soviet Union was the economy most harmed by these low oil prices. It also had a communist form of government. So this is really interesting. So here it says, raising rates put the brakes on higher oil prices. So raising rates kept a lid on credit creation and demand escalating too much to the point where energy consumption grows to the point where it increased oil prices to some huge price level. The Soviet Union was harmed the most because lower oil prices, it also had a communist form of government that did not work well compared to capitalism. Ultimately, the central government of the Soviet Union collapsed in 1991. So the Soviet Union wasn't capable of producing oil below the oil prices around the world at the time because they were a communist form of government, and allocation of capital is always inefficient in these forms of government, and so bringing their cost curves were just well above the price of oil, and so they just weren't able to keep up with the Western world as such. Now, the rise in interest rates during 2022 and 2023, in the chart above, correspond to a very different situation. Extraction of fossil fuels, in particular, the heavy oil used to produce diesel and jet fuel, is no longer growing rapidly. Instead, what has been growing is debt, especially government debt. Figure 6 shows U.S. government debt through April 2023. U.S. government debt spurted towards in 2020 and is still rising rapidly. So, yeah. So, we're not growing our oil supply, our production, in diesel and jet fuel production. We're just growing our debt. And the interest payments on that debt is growing at an even faster rate. The business closures in 2020 and interruptions in travel reduced oil prices and provided a good excuse for more government debt. All this debt added buying power, but it didn't actually produce very many goods and services. Instead, it added a debt bubble. Similarly, investing close to useless green energy temporarily added GDP, right? Because these are all subsidized through the government. Government subsidized loans, but GDP doesn't care. It just just keep adding it to the bottom line. But it mostly added a huge debt bubble, raising interest rates likely to burst these debt bubbles. The U.S. and other rich countries have also put in place pension plans for the elderly. These are not treated as debt, but they depend upon resources of all kinds being available to feed, clothe, and provide shelter to a growing army of retirees. If there is not enough diesel to allow as many goods and services to be produced as are produced today, there's likely to be a huge problem if payouts to pensioners aren't significantly reduced. Other citizens will be unhappy if retirees get a disproportionately higher share of the reduced supply of goods and services. Some will say, why work if retirees and pensioners get more than those of us that are still working? Yeah, so I mean, you're starting to stoke envy between the classes. Thus, the world seems to be increasingly in a situation where more squeezing out will take place. Major governments, especially those with pension plans for their citizens, seem especially vulnerable. No one understands that there has been a temporary rapid rise in energy consumption per capita in the 1950s and 1980s. That led to a temporary spurt of interest rates on bonds. This temporary rise in interest rate made pension programs look far more feasible than they really are for the long term. So how many points? Oh, we're actually almost done. All right, last point, number 13. How does the problem resolve itself? It seems to me the problem of debt bubbles and of unaffordably generous pension plans is very widespread. Analysts of all kinds have missed the hidden brakes on the economies caused by inadequate energy resources of all kinds relative to the rising populations. The population is rising. Energy resources aren't keeping up with the population increase. In some cases, they're actually coming down. Collapse of at least some central banks seems possible. Perhaps some of these collapses can be postponed by rollbacks in government-sponsored programs, particularly those for the elderly and for those who are not working, your pension plans essentially. But even aside from the pension problem, there is a problem with many debts that are not being repayable in an economy that is forced to slow. As described in section 11, many other problems have become iffy as well. For instance, derivatives may not be able to pay as planned. If there are problems with inadequate supply of essential materials, they are likely to spill over to asset values. For example, a farm that cannot purchase fuel for its agricultural equipment, in some sense, is not worth very much, since workers with simple tools like shovels cannot produce very much food. Likewise, a factory permanently broken supply lines is not worth much either. So yeah, I mean, it essentially brings down the net value of the government, of the society, the country, the region, whatever. Because all of a sudden you have all these businesses that are worth next to nil because they don't have they just don't have the inputs to produce their outputs. All right, and I wish I could provide a happier ending. The closest I can come up to such an ending is to say that it appears to me that there's a literal higher power that's somehow providing an enormous amount of energy in a way that allows the universe to continually expand. This literal higher power is in some way influencing the world today through the self-organized nature of the economy. Okay. So, yeah, guys, it's, wow. That was really in-depth. Even I didn't know how in the hole we were when it comes to all of the things that are tied to energy production. You've got a double whammy, essentially. You've got an ever-expanding debt bubble with ever-expanding interest, with ever-expanding payments on the interest of that debt bubble. But at the same time, the energy needed to produce value to pay off those debts, those interests on the debt, are coming down. It's decreasing. So it's becoming harder and harder to produce value in a time when value needs to be produced higher than ever. So, yeah. So this article is actually a little bit of a 180 from the last. This paints a picture that Saudi Arabia might actually have more oil than we really know. The title here is from Reuters, Saudi Arabia's oil reserves. How big are they really? So it starts off, how much oil lies beneath the deserts of Saudi Arabia? And how long will it last before running out? Is a question that has intrigued and confounded oil experts for 5 decades. The kingdom has proven resources of 266 billion barrels, according to government estimates submitted to the organization OPEC, essentially. Okay, kind of put it in perspective. The world uses about 100 million barrels a day of oil, so that's about 365 million barrels a day. You divide that by 266 billion divided by 365 million. Saudi Arabia essentially has enough oil to power the world at current levels for what? 600 years or something? Yeah, it's like over 600 years. If these numbers are correct, Saudi Arabia's reserve will last for another 70 years at the average production rate of 10.2 million barrels a day for the reported 2015. But there is widespread skepticism about the official estimates. Hold on, guys. Let me turn off the night light. Looks like my screen is getting red. All right. But there is widespread skepticism about the official estimates, which were abruptly raised without expectations from 170 billion barrels in 87 to 260 billion. So they have some explaining though, going from 170 to 260. Official reserves have remained constant every year since at 260 to 265 billion barrels, even as the country has consumed or exported another 94 billion barrels. If the data is accurate, the kingdom has managed to a remarkable feat of exactly replacing each produced barrel with new discoveries or increased estimates of the amount recoverable from existing fields. But most of the country's giant and supergiant oil fields were discovered between 1936 and 1970. and no comparable discoveries have been made since. So, this huge reserve of oil, they were all discovering these oil fields nearly 50 years ago, 50 to some 80 odd years ago. The implied increase in reserves must therefore come from enhanced estimates of the amount of oil recoverable from existing reservoirs. The problem is that field-by-field production profiles and reserve estimates are state secrets, known only by a small group of insiders, making it impossible to verify them or test them. So their numbers are very opaque. There's no way to really get a true understanding of what they're saying is true. Analyzing Saudi reserves and trying to predict when the kingdom's production will begin to decline has been a graveyard for the reputation of professional oil analysts. The kingdom is currently producing more oil than ever, defying prediction that its output would peak and then fall. So, this kind of defies the peak oil narrative, and in some ways actually defies the article that we read before, because it seems like Saudi is producing more oil than ever before, or has the capacity to at the very least. All right, reserve estimates. It says the oil industry employs a number of different ways of classifying the amount of oil available for future production. The broadest category is the total number of original oil in place, OOIP, and the reservoir formation before production began. In the 70s, there was a broad agreement that the OOIP of Saudi Arabia discovered oil fields was around $530 billion. The estimates for original oil in place was reported to the U.S. Senate Subcommittee on International Economic Policy by executives for Aramco. Aramco was then jointly owned by 4 U.S. oil companies. This included Exxon, Texaco, SoCal, and Mobil, as well as the government of Saudi. So its owners and executives would be required to testify. And so the subcommittee report, now 40 years old, contains some of the last detailed info about Saudi's reserves in the public domain. But not all of the original oil in place can be produced technically or profitably, so most analysts focus on a series of narrower measures which look at the amount of technically and economically recoverable reserves. So there is this huge amount of oil that the Saudis can tap into, but some of that oil is actually very costly. And so what they're saying here, it might make more sense to actually look at a narrower band of that oil, taking into account costs in the process. Proved reserves, the most conservative and prudent measures are those which are estimated to exist and are technically and economically recoverable with a probability of at least 90%. Okay, so they're saying there's a fraction here of reserves that are recoverable, and they define that as being recoverable with 90% probability. Probable reserves are those estimated to exist and be commercially recoverable with a profitability of at least 50%. So you've got proved reserves and you've got probable reserves. Proved reserves, as we just talked about, are those that are reserves that are recoverable with a 90% chance of probability. Probable reserves, on the other hand, are those reserves that are commercially viable and recoverable and profitable with a probability of at least 50%. Possible reserves, the most speculative and optimistic measure, are estimated to exist and be commercially recoverable with a probability of at least 10%. So you've got possible, probable, and proved. So these are 3 different levels of reserves. Obviously, your most guaranteed reserves are your proved reserves, followed by your probable reserves, and finally your possible reserves. Your possible reserves, the criteria there is that it has to be recoverable commercially with a probability of at least 10%. So the bar is really low on that subset. In the late 70s, Aramco put proven reserves at around 110 barrels, while the more speculative categories of probable and possible reserves were put at 178 billion barrels and 248 billion barrels, respectively. So proven reserve is the highest level of reserves. That puts Saudi Arabia at 110 billion barrels. Next in line, your probable reserves at 178 billion, and then 248 billion for your possible reserves. So there's a huge range. You've got 110 to potentially 248 billion barrels of oil that Saudi Arabia can pull from. The question of which to measure for production and planning purposes is a matter of judgment and cost controversy between Aramco partners and the Saudi government. So now they're going to dive into proved versus probable. Since 1980, the Saudi government has been the sole owner of Aramco from 82. Detailed field-by-field info about the company's reserves and production has been restricted. Saudi began reporting to OPEC that its proved reserves stood at around 168 to 170 billion barrels of oil. Saudi figure was much higher than the 110 billion of proved reserves, right? Proved reserves are those reserves that are 90% probable of being commercially viable. So Saudi actually bumped up the amount of proved reserves from 110 to 170. This was back in the 80s. But it was very close to the figure for possible reserves that the Aramco partners reported to the Senate, U.S. Senate. That raised the question if Saudis had chosen to increase their reported reserve base by reporting probable reserves as proved reserves. But yeah, I mean, there's no way to really verify any of this. In 1988 to 89, well, I mean, they did have testify in front of the Senate, so there's that. But to actually get the data and look at it, I don't think Saudis made that information apparent. All right, so it says here in 1988 to 89, proved reserves figures jumped again to 260 billion barrels despite no new major discoveries. So you go from 110, then they tell you it's 170, and now they're telling you that's 260 billion of proved reserves. So what does that make your possible reserves then? This was much higher than the proved reserves reported by the Aramco partners, but not far off the figure of 248 billion for possible reserves they had reported in the 70s. Again, that posed the question whether the Saudis were reporting possible reserves as proved reserves to increase the size of their reserve base. The Society of Petroleum Engineers and the U.S., the SEC in the United States have strict definitions for estimating and reporting reserves. But it is far from clear that the proved reserves which Saudi has reported to OPEC employ the same definitions because the calculations are secret to outsiders have no way of verifying them. Yeah, so I mean, nonetheless, they still got a lot of oil, essentially. All right, so reserve growth. It is not uncommon for countries to produce far more oil than initial reserve. Estimates suggested would be possible. Reserve increases can come from the discovery of new oil and gas deposits or from an increase in the estimated amount of oil that is commercially recoverable from an existing field. Reserve growth from existing fields, also known as field depreciation, is one of the most important sources of increases of oil reserves in most countries. So one possibility is that the oil fields from which they reported their initial reserves from, 110 billion proved reserves, they may have just found more oils more oil, more oils. Give me all your oils. More oil in those fields. So that's a possibility. As understanding of the reservoir increases, more info is known about its extent, and new technologies and techniques become available. The amount of technologically recoverable oil may rise. So, you might have a case of new technology comes on the scene, and it's capable of pulling and identifying more oil than was initially reported or inspected. But then it says here, Saudi seems to have been unusually reliant on reserve growth within existing fields to revise its reserves up to 265 billion barrels and keep them there since the late 1980s. Saudi leaders have announced plans to seek a stock market listing for Saudi Aramco to make up to 5% of the company's shares available to investors. That's interesting. The prospect of partial flotation has triggered renewed interest in Aramco's reserves, since they could be an important part of any valuation. If Saudi Aramco was required to comply with normal listing rules, it would have to take much more information available about its reserves and how they are calculated. So yeah, if they choose to go public and just says 5% of the company, then they're going to have to divulge what they have. But there are reasons to be cautious about expecting much more transparency. It's far from clear that any share sale would include ownership of the reserves to the ground. In the meantime, no one really knows how much oil. Okay, yeah. Essentially, that's really it. A lot of these increases in Saudi's oil appears to be coming from existing oil fields. This firm, Rystad Energy, they put Saudi's proven oil reserves at 70 billion barrels, and its proved and probable reserves at 120 billion barrels. So they're a little bit bearish on Aramco here. Saudi. If new field discoveries are included, the reserve figures could grow to somewhere between 168 to 212 billion barrels. And the U.S. now holds more oil reserves than Saudi Arabia. All these figures are potentially below the official numbers for proved reserve, blah, blah, blah. Yeah. So, we really don't know. Saudi's kind of telling us that they have more than they're letting on. But I guess we'll know in due time if they go public with Aramco. This is another article along the same line, kind of conflicting with the peak oil narrative. It says here, Middle East geology. Why the Middle East fields may produce oil forever. And the highlights are, like we talked about, increase in Saudi oil reserves. Section across the Arabian Peninsula during the Miocene, when the Red Sea began to open. It showed the rift zone over Ophiolite and the Tethys Sea before the Yoprik movement occurred. So these are all. So they're identifying new oil fields within the Arabian Peninsula. Rift zone and magma chambers are magnified. A section showing the eastward movement of the Arabian Peninsula. So this is more of a topographical case for Middle East oil production. So it says here, the topography of the Middle East as it exists today is the result of a geodynamic system reflected in the creation of subduction zones in Oman, along the Persian Gulf, along the Syrian-Turkish borders, and along the eastern shore of the Mediterranean Sea. I mean, do you guys have any pictures? I don't think they do. But yeah, let's just skip down to the conclusion, because they get into a little too deep into the geological and topological nitty gritty. So it says the conclusion: the two major ingredients, carbon and hydrogen, necessary for the formation of hydrocarbons in the Middle East, can originate from organic or inorganic sources. Hydrocarbons should be continuously forming in the Persian Gulf to account for the annual increase in oil reserves. Modest oil reserves in Oman, Syria, and Turkey can be attributed to inadequate seepage of water, which is a hydrogen source. The lack of hydrocarbons to the east of the Ophiolite mountain in Oman can be attributed to being out of the subduction zone. The location of oil and gas fields nearby or above subduction in rift zones in the Middle East relates to the formation of hydrocarbons to geodynamic activities. The counterclockwise movement of the Arabian Plate since the opening of the Red Sea in the Miocene in the chemical process, which generates and combines carbon and hydrogen at 300 to 500 degrees Celsius within subduction zones or deep in the basement of the rock. So yeah, they're essentially saying that there's more sections, places to pull out hydrocarbons from. They get a little too scientific, a little too deep into the nitty gritty there, but that's essentially what they're saying. Let's go ahead and look at some charts before we close things out. And let's pull up. Let's kick things off. Let's look at the oil price. Oil's been acting really weird. So oil closed the week at $80.50 WTI. So yeah, we had a pretty big red candlestick on the week. And we broke down below this support level. So despite all this conflict in the Middle East, oil continues to trade down. So that's interesting. Powell did signal that rates are going to stay higher for longer. So there could be that. But oil prices have been kind of schizophrenic lately. It's really interesting to see. You look at this from a long-term lens. You can clearly see oil was squeezing here all the way up until the summer. It broke out, formed a upward trend line here. Now we're breaking below that upward trend. We'll see where that takes us. But I will say the week prior, we had a hammer candlestick before that. So that was signaling upward move. And the oil price, despite closing in the red, you still had the buyers beating the sellers with this, going from all the way down here at the very bottom of this week and being able to close it at the top. That shows more power on the buyer side than on the seller side. So oil has broken down below its support. We may come back and retest, but otherwise, if we don't, then the next level we may reach is probably somewhere around this $76 zone. I'd say probably around 75, somewhere around $75. That's probably your next level. And that also coincides with a lot of the action going on here, right? A lot of buying and selling at this level. So between 70 to 75, that's probably where oil is headed to next, provided that there isn't any major changes in the war between Israel and Gaza. Let's look at uranium. Uranium has been doing some really, really cool things. You see uranium here moving up this support line, hugging the support line, breaking out of this resistance line, breaking 12-year highs, not seen since 2011, pre-Fukushima. And we closed at $74 on the week. And you just look at all these weekly candlesticks on the uranium side. You know, we've been crushing it up higher, higher, higher. And, you know, we did have a bit of a red day. That's fine. You know, there's got to be some form of profit taking. You can't just keep going up forever. But really good news on the uranium front. I also want to bring this to your attention, guys. You know, if you look at uranium and you compare it with the entire commodities complex. So this is the uranium spot price divided by the commodities ETF or index, the Thomson Reuters Commodity Index. You'll notice that commodities have been outperforming, uranium has been outperforming commodities for the better part of several months now, all the way out from May up until present day. I mean, just check this out. Check that out. So, uranium continues to prove itself the rock star of the commodities. Gold, in much the same way that oil has been rather confused, kind of schizo, moving up and down. Gold has really been stuck in this 1970s to 2000 level. We did close out the week with a hammer candlestick that signals an upward trend. That signals a higher probability of a continuation of growth in terms of gold. The week prior, I wouldn't call this a hammer candlestick. The wick isn't long enough to justify it. But I think gold will continue to move up higher, especially as, you know, we just got another report with more record buying of gold from these central banks across the world. So if they're buying gold, and, you know, as we looked at before, I mean, we looked at all these articles in this, you know, so far in this stream, you know, the system is not in good shape. Debt is spiraling. The energy needed to service that debt is becoming harder and harder to get. And so there's going to be whole wide system collapses. And so when a new system of exchange makes itself known, it's going to use gold, most likely. That currency is going to be backed by gold. So I think that's probably why all these central banks are buying up gold like never before. You know, they can see the writing on the wall. And gold has been stuck here. Can't seem to break above this $2,000 level, you know, at least on a long-term basis. So I think that's it for now, guys. We've been going for damn near 2 hours now. You know, thank you guys for watching. If you enjoyed this content, go ahead and like and subscribe down below. Also drop me a comment. Do you enjoy the news articles? Do you enjoy the TA analysis more? You know, what do you want me to spend more time on? Let me know. Also, if you found this video helpful and informative and you feel like, you know, it'd be really good for other people to be aware of where we're heading by way of an energy crisis, a sovereign debt bubble crisis, and so forth, then, you know, by all means, go ahead and share the video, and you know, just continue to let me know. Continue to let me know what you think. Send me news articles, charts, etc. I really appreciate you guys. Thank you so much for watching, and I will see you in the next episode. Bye, y'all.